Is there some relief in store for mortgage rates in the near term? There could be. We're seeing some signs in the technicals that the selling pressure may be abating, at least for a short time. We'll get into that on this Technicals Tuesday. My name is Aaron Montel from Macro to Mortgage. Yes, it's true. The selling in bonds may be abating, if even just temporarily. Let me share my screen here, and I'll show you what I've been noticing with the technicals. First, of course, a little bit of a level set here. The Federal Reserve started cutting their benchmark Fed funds rate back in September, and since then have cut 100 basis points. We're now 425, 450. Higher end of that, frankly, is where we're sitting. But what's very unusual, and this actually hasn't happened since the early 80s, that was the last time the Fed entered a cutting cycle and 10-year rates rose to the degree that we've seen for the amount of time that we've seen. The last time we saw that was in the 80s. And as the Fed has cut 100 basis points from the Fed funds rate, the 10-year Treasury has now matched it and beat it, rising more than 100 basis points since September. So very unusual. And the trend in mortgage rates and the trend in interest rates is clearly bottom left to upper right, so higher. But a pullback may be coming. Yeah, we may be getting a little bit of an improvement. There's a chart of the Fed funds rate, just expressed in a different way. That cutting cycle beginning back in September. The Fed funds rate actually front running the Fed a little bit, and then in since then, as I mentioned, the U.S. Treasury 10-year Treasury yield has risen by more than 100 basis points, putting a new fresh high today. As a matter of fact, today being January 7th, 2025. And the high was 4.699, just a whisker short of 4.7 today on 10-year Treasury yield, which is a higher high for this run compared to the last high, which was back on the 27th of December. So now we have a new higher high. But here's one of the encouraging technicals that I saw earlier today is we currently have a negative divergence that is forming on the 10-year Treasury. What is a negative divergence? It's where price, or in this case, yield, makes a higher high, but yet an indicator that moves in tandem with price or yield is not confirming, and that's what we see here. So you can see we have a higher high in yield, but yet the RSI is making a lower high, at least so far. This is a signal that portends slowing momentum, and that maybe bond sellers are becoming somewhat exhausted, or just need to go backstage and grab a couple puffs of oxygen. Whatever the case may be, the selling pressure may be abating for some time. How long remains to be seen. But these types of divergences can often lead to pullbacks or just sideways consolidations. One of the two is typically what we see. So hoping for a little bit of a pullback here. And as you might imagine, if we jump over and look at the bond itself, 10-year Treasury futures is what I prefer to follow. It's the mirror image of what we just looked at on yield. Slightly lower low, but a higher low so far on RSI, which is a positive divergence. Again, mirror image from looking at yield. I like looking at Treasury futures because it's a huge market. The U.S. Treasury futures market, about $1.5 trillion notional dollars value, right? So that's pretty big. Been tracking this channel back to October 23, and you can see we've been just locked in this channel since then. Back in December, the Fed meeting in December was the catalyst to break the channel. It's been a series of bear flags, frankly, since for some time now, going back to October 2022. You can see what typically happens in a bear flag: run higher, break out, and move lower. And that's what I expect to happen here. But in the meantime, see how this, if we were to extend this line just a little bit that way, and I'm just eyeballing it here, see what happened? Price came back up and tagged that line before moving to the downside. We saw that. I don't count this. It didn't actually touch. So I'm hopeful that we still see price move higher, tag that, and then unfortunately, I would expect it to move much lower. But in the near term, this creates an opportunity. If you have loans in your pipeline, whenever this happens, consider that a win. And I would personally, I would start locking those loans. If I'm a trader, which I am, not offering any type of advice, but this might be an opportunity, depending on your risk profile. This might be an opportunity to put on some short deltas in 10-year treasuries. Who knows, right? But this is kind of what I would expect to see is if in fact these divergences that we're observing play out, we might see bond prices rally up here, touch the bottom side of this trend line, and then I would expect it to move lower, but not until then. Anything's possible, but probabilities say we're going to get a little bit of a bounce. Whether it gets here or not, no certainty there. But typically, we see these trend lines, especially lines that are this solidified, that go back this far, years, and have had several touches. Usually, they have to be tested, and we just haven't seen that yet. So I would expect that at some point in the next several weeks, maybe month or so. Not sure. Another encouraging sign is the U.S. dollar. It has just been on a tear, a parabolic move since the Fed hiked interest rates. I'm sorry, since the Fed cut interest rates back in September. Pretty important distinction. Since the Fed cut interest rates, the dollar has just been screaming higher, having put in a new high here. Of course, if we look back, we had a real high back here in 2022. This was Russia invasion of Ukraine. It was that time period. So um, definitely had a catalyst. But since then, we've been staying below this uh, horizontal resistance line until now, or until recent, at least. But we are starting to see a little bit of weakness. I'm not too excited about this yet, but definitely watching. I want to see this trend line in the dollar break. I imagine if the first thing we're going to see is this trend line in the dollar break, and then we'd probably see that bounce in bonds start to materialize. So this is what I'm going to be looking for first, because of course the US dollar is directly related to treasuries. And by the way, what we're looking at here is the DXY, which is the US dollar against a basket of other currencies. So some really encouraging signs that the selling pressure in US treasuries may be taking a break for a minute. Sentiment may be changing. I posted this on Twitter some time ago, back on December 23rd. And if you like these types of posts, please, I would encourage you to follow me on Twitter at Aaron Montel. Back on December 23rd, I noted a 6 put call ratio for 10-year Treasury futures options. And I watch the options market because, as I mentioned, the futures market is about $1.5 trillion in notional value. The options market is about $1 trillion in notional value. So, like a lot of other financial markets, including the equity markets, by the way, we are slowly watching the tail, that is the options market, become the dog. At least that's my opinion. So I pay close attention to the options markets. Back in on the 23rd of December, that is incredibly bearish sentiment. Incredibly. I'm not sure I recall much seeing a higher put call ratio than that at any point. Granted, on the 23rd of December, it was thin trading, so it can move around a little bit more than it would on most days of the year. But nonetheless, called that out. And I did note that a spark could ignite a short covering rally. And it sure hasn't. There sure hasn't been a spark. But that potential still exists because I think net people are still pretty short the treasury market. However, what I noticed today was also encouraging as I was doing my day end analysis of the options market. Put call ratio now below 1. And for those of you that don't know, put call ratio basically is how many puts to how many calls. And a put call ratio of 1 would say an equal number. A put call ratio of 1.5 would say more puts than calls. So a overall bearish sentiment. Here under 1, we're slightly more bullish. So there was slightly more calls than puts transacted today. And you can see that from total volume here. But what I wanted to point out was here in this options chain, this is a pretty big contract, a 6,000 lot of 120.25s that would expire next week 2. Somebody, I probably either bought these, but more likely covered them is what I'm going to surmise here for less than they sold them for. So somebody some time back at some point in the past sold 6,000 calls contracts at 120.25, and today took those contracts off, paid to cover them. And why would one do that? Well, one would do that because the one would perceive that risk reward had shifted, and perhaps this person is noticing the same thing I'm noticing, that selling pressure is starting to abate in the treasuries market. And not that there's going to be a change in trend. I certainly don't expect that, but at least maybe a near term rally, as I pointed out, testing some of those previous support and resistance lines. So it's a tough market out there. It's important to watch the financial markets, the options markets, and not just pay attention to the economic data, because, like I said, and I'm sure there's some opposition, but I believe these markets are becoming the dog rather than the tail. I'd love to hear your thoughts. Please comment below, and also if you enjoyed this video,